Disclaimer: something is shifting beneath the surface of the global financial system, and it is not happening loudly. There are no emergency speeches, no red banners on news channels, no sudden market halts. Instead, it is happening quietly, deliberately, and far away from public attention. And historically, those are the moments that matter most. After Japan began selling large portions of U.S. treasuries to defend its currency, most analysts framed it as a regional problem, a technical response, a short-term maneuver. But while the world was focused on bond yields and exchange rates, a far more telling move was taking shape elsewhere, one that had nothing to do with interest rates and everything to do with trust. Germany began reevaluating where its gold actually was, not where it was listed on a balance sheet, not where it was assumed to be, but where it physically existed. Because when confidence erodes, paper stops being enough. Germany is not a speculative economy. It does not chase trends or gamble on narratives. It is methodical, conservative, and shaped by historical trauma. Inflation destroyed Germany once before. Currency collapse rewrote its society. That memory is institutional, not emotional. It lives inside policy. The German central bank holds one of the largest gold reserves on earth. Thousands of tons accumulated over decades of trade surpluses, discipline, and restraint. Gold is not an investment for Germany. It is a foundation, a last line of defense. And yet, for most of the post-war era, much of that gold was not inside Germany. It was sitting beneath New York City. That decision traces back to fear, not faith. After World War II, Germany rebuilt rapidly, but its geography never changed. It sat exposed directly between two hostile blocs. During the Cold War, planners assumed that if conflict erupted, Germany would be the battlefield. Gold stored domestically would be lost within days. So Germany did what many nations did at the time. It sent its gold to allies, to places it believed would survive even if Europe did not. London, Paris, and most significantly, the United States. The vaults of the Federal Reserve Bank of New York became one of the largest gold storage sites in human history. Deep underground, reinforced, guarded, trusted. For decades, no one questioned the arrangement. The Cold War froze, then faded. The Berlin Wall fell. The Soviet Union collapsed. The tanks never came, but the gold stayed. Year after year, the bars sat far from German soil. And as long as the system functioned, no one asked uncomfortable questions. Gold held abroad became just another line item, another assumption. Until assumptions met reality. In the early 2010s, Germany's federal auditors did something mundane and revolutionary at the same time. They asked for verification, not statements, not assurances, verification. When was the last time Germany's gold stored abroad had been physically inspected? The answer was unsettling. There had never been a full physical audit. For decades, Germany relied on written confirmations from foreign custodians. No serial number verification, no random inspections. No direct confirmation that the specific bars deposited decades earlier still existed in the form claimed. This was not a conspiracy theory. It was a bureaucratic fact. The auditors were alarmed. Their report criticized the central bank for applying weaker controls to national gold reserves than a small business would apply to inventory. The report leaked. Public confidence eroded. And something changed in the national conversation. A simple idea gained momentum. If Germany does not physically control its gold, then it does not truly own it. Pressure built. Political resistance weakened. And in 2013, Germany announced a plan to bring significant portions of its gold home. This should have been unremarkable. Gold is heavy, but global logistics move far heavier things every day. Aircraft engines, industrial machinery, entire bridges. Yet the response from New York was strange. Yes, the gold could be returned, but not quickly. The timeline stretched across years, 7 years to be precise. That detail alone should have set off alarms. 300 tons of gold sounds enormous to individuals. To global logistics, it is manageable. A limited number of secure cargo flights could move it within months. Instead, Germany was told to wait most of a decade. That delay suggested something fundamental. The gold was not immediately available in the form it was supposed to be. The explanation given publicly focused on logistics, security, and careful handling. But privately, analysts began asking harder questions. Had the gold been leased? Had it been swapped? Had it been used as collateral in financial transactions? Because gold that is truly allocated and untouched does not take 7 years to retrieve. Germany had unknowingly tested the system, and the system strained under the weight. When the gold finally began arriving in Germany, officials expected closure, but the details raised new concerns. Many of the bars were newly cast, modern stamps, fresh surfaces, no historical continuity. The explanation was technical. Old bars were supposedly melted down to meet modern delivery standards. But in custodial finance, melting is not neutral. It erases history. It destroys serial continuity. It removes the ability to prove that what was returned is what was originally deposited. Germany received gold of equal weight and purity, but it did not receive the same gold. That distinction matters because it implies that at some point the original metal left the vault, and that realization forces a much broader question. If this can happen to Germany, it can happen to anyone. What Germany encountered was not a logistical anomaly or an isolated accounting irregularity. It was a structural feature of the modern gold market, one that exists by design and survives only as long as confidence remains intact. Most people imagine gold trading as something physical, bars moving between vaults, coins changing hands, metal being weighed and verified. But in reality, the vast majority of gold transactions never involve gold at all. They involve promises, digital entries, contracts that reference gold without requiring its delivery. In the world's largest trading hubs, price discovery happens almost entirely through paper instruments. Futures contracts, options, swaps, and unallocated accounts dominate the market. These instruments create the appearance of massive liquidity, but that liquidity is largely synthetic. It exists because the same underlying metal is referenced again and again for every ounce of physical gold sitting in an approved vault. There are many times that amount in outstanding claims. The exact ratio is impossible to know with certainty, but what matters is not the number. What matters is the assumption behind it, that most participants will never ask for delivery. As long as that assumption holds, the system appears stable, prices move, trades settle, confidence remains. But the moment delivery is requested in size, the system is forced to confront reality. This is where Germany's experience becomes instructive rather than exceptional. When Germany asked for physical metal rather than continued assurances, it forced a conversion from abstraction to substance. And that conversion is where leverage becomes visible. A system built on overlapping claims works only when claims remain theoretical. The legal framework reinforces this structure. In many custodial arrangements, gold is held in unallocated form by default. That means the holder does not own specific bars. They own a claim on a pool. In calm conditions, this distinction seems irrelevant, but in stress conditions, it determines who owns metal and who owns paperwork. Germany understood that in a systemic crisis, legal priority matters less than physical control. Vault access matters more than contracts. Possession becomes certainty. This realization aligns directly with broader shifts in the global system. Japan's decision to sell U.S. treasuries was not ideological. It was mechanical. The yen weakened. Defending it required dollars. Dollars required liquidation. But the implication of that sale extended far beyond Japan. It demonstrated that even the largest and most disciplined holders of U.S. debt may be forced to choose between domestic stability and external obligations. That choice reverberates through every balance sheet holding dollar assets. If major holders continue selling, the Federal Reserve must either allow yields to rise sharply or absorb supply. Allowing yields to spike risks, destabilizing financial markets. Absorbing supply requires money creation. Money creation preserves stability in the short term, but weakens purchasing power over time. Germany understands this trade-off deeply. Its economic model depends on price stability. Inflation is not an abstract risk. It is a historical scar. Holding large reserves in a currency facing structural pressure introduces vulnerability. Gold does not share that vulnerability. Gold is not someone else's liability. It does not depend on fiscal discipline, political decisions, or central bank credibility. It simply exists as an asset without a counterparty. This is why physical location matters. Gold held within national borders can be mobilized in a crisis. It can be pledged, swapped, or used to restore confidence in a currency. Gold held abroad is subject to jurisdiction, access, and prioritization decisions that may not favor the owner during stress. Germany's remaining gold held overseas represents a calculated exposure, but calculations change when risk profiles shift. As confidence in the post-war financial architecture weakens, the incentive to reduce counterparty exposure increases. Repatriation becomes not a political statement, but a defensive one. If multiple nations pursue similar strategies, the impact compounds. Physical gold leaving the international banking system reduces the inventory available for lending, leasing, and collateralization. That reduction tightens the system. Leverage becomes harder to sustain. At that point, the relationship between paper markets and physical markets begins to fracture. Prices quoted on exchanges reflect expectations and settlement mechanisms. Prices in the physical market reflect availability. When availability tightens, premiums rise. When premiums rise persistently, the two prices diverge. This divergence is not a sudden explosion. It is a process. It starts quietly. Delivery times extend. Minimum purchase sizes increase. Allocations are delayed. Then eventually, metal becomes scarce at posted prices. Germany's actions matter because they occur early in that process. This is not a race for profit. It is a race for position. Nations that secure physical assets early do so at current valuations. Nations that wait are forced to compete in tighter markets. The advantage belongs to those who act before stress becomes obvious. Germany is not attempting to dismantle the system. It is adapting to it. It is responding to signals that trust-based arrangements are becoming less reliable in a multipolar, debt-saturated world. This is why the story resonates beyond gold. It reflects a broader shift in how risk is perceived. Counterparty exposure is being reassessed. Assumptions built over decades are being tested. The most important insight is not that gold might become more valuable. It is that confidence, once questioned, cannot be restored by assurances alone. Germany is not panicking. It is positioning. And history shows that when the most cautious actors begin adjusting quietly, it is not because danger is imminent, it is because danger is possible. That distinction makes all the difference. Nothing in this analysis is financial advice. It is an observation of how the largest players on the board are moving in real time. If this breakdown helped you see the system more clearly, make sure to like the video, share it with someone who still trusts the headlines, and subscribe to the channel for more deep, documentary-style analysis that goes beyond surface-level explanations.